I'm currently up almost $5,500 just this month in Tesla cash secure puts. In this video, I'm going to show you why Tesla is my favorite stock to generate income on a monthly basis. As a matter of fact, enough income to replace a full-time job. So first, I'm going to show you why Tesla is so special more than the top 10 mega cap companies, why I choose Tesla to continue my option selling program. And then I'm going to dive into how I sell options on Tesla on a monthly basis. And lastly, I have a surprise for you, because most people leave money on the table when they lock up the collateral required to sell puts. For instance, when you sell puts, you are locking up collateral, and most people don't know that they can actually earn as much as a high yield savings account or a treasury on the collateral that's being used in the cash secured put. This is something that I don't see talked about a lot. Also, instead of putting your money just in a high yield savings account or a treasury, you can make your money work for you by earning the same yield or a similar yield and using that money to sell options for regular income. Also, it's important to note that you don't have to use Tesla. You can apply this to any stock that you want to buy. I just use Tesla as an example because it's my favorite one, and it's the one that I get the most questions about on Instagram, Twitter, and YouTube. I also sent out the last Tesla idea on Twitter and Instagram, so make sure you're following me on both of those if you want daily trading and finance content absolutely free. Let's get right into it. All right, so why do I choose to do this on Tesla? Well, if you look at the top 10 mega cap companies, you have Apple, Microsoft, Amazon, Nvidia, Google, Tesla, another Google, Meta, Berkshire Hathaway, and Eli Lilly. Now, of these 10 here, which one do you think is the most volatile? Which one has the highest beta measure? Beta is just a measure of volatility or risk. No, it's not Tesla, it's actually Nvidia. Now, that's not surprising considering Nvidia's up 221% year to date, and also carries a PE ratio of 109, the highest out of any of these companies in the top 10. However, Tesla is second on that list in what we call beta. It is a 1.52, so the second highest out of all of those companies in the S&P 500. But Tesla is by far the best in terms of revenue growth out of any company in the top 10. That includes Berkshire Hathaway, Apple, Microsoft. That even includes Nvidia, which is supposed to be on a massive growth spurt at the moment as it's part of the AI bubble. But Tesla is almost twice as much as Nvidia as it relates to compound annual growth rate. So as a mega cap company, I'm actually really bullish on Tesla, much more so in terms of growth than the other companies in the top 10 in the S&P 500. Nvidia would be second, but Nvidia is already inflated as its PE ratio is 109. So not only is Tesla a mega cap, Tesla also has an insane growth rate. Ever since it turned profitable, its stock price is up 2,000%. And more importantly, it has a very high moat. It has a really rabid fan base that won't let the stock drop without picking it right back up again. As we saw when it dropped to 101 in January, it was bought up almost instantly, and it is now trading at more than 2.5 times that. So because Tesla has a rather high beta, if you look at its option chain, Tesla actually has inflated premiums. Tesla's premiums are some of the best in the options market, especially for a stock that's priced in the mid 200s. So let's talk about strategy here. What is my strategy with making income off of Tesla options? Well, it's really pretty simple, especially if you've studied options. For me, I sell cash secure puts on Tesla, usually around the 30 delta, because that gets me around the $1,000 mark per contract. And by the way, if you want access to all of my trades, including my Tesla option selling, as well as the general option selling alerts, make sure you click the link in the description. Come join the group. You can join on a monthly basis, which is really the cheapest way or the cheapest ticket to enter the academy. I just sent out a fresh batch of alerts on Tesla cash secure puts, which are already up 31%. So why do I pick the 30 delta? Well, for those of you that are unfamiliar with options, you can use delta as a rough measure of a chance that strike price will get hit. So at the 250 strike price expiring October 20th, the time of this recording is September 12th, there is about a 30% chance that Tesla will hit 250 or lower, because this is the 0.3 delta option, the 0.3 delta strike. Now I'm getting around $1,000 per contract to sell this. Now, if you went further out, say to the December expiration, the 0.3 delta will pay you $1,500. Yes, that is 50% more, but I'm going to have to wait 2 more months for that option to expire. If I hold it to expiry, we'll talk about that in a second. I'm going to have to wait 2 more months for that option to expire. And I would much rather sell options on a monthly basis than on a 2 to 3 month basis, where I can collect $1,000 every month rather rather than collecting $1,500 every 3 months, if that makes sense. Also, I get to be more robust and see what the stock is doing and maybe adjust my strike prices for the following month's cash secured put. Now, before I move on to other strategies, let's talk about what are the consequences of selling this cash secured put. If you sold the 250 put at $1,000, right now Tesla's trading at almost $268. If you sold the 250 put at $10 or $1,000, you have to multiply every options contract by 100, then you would be assigned Tesla at $240. When would you get assigned? Technically, in American style options, you could be assigned at any time. But in this case, most of the time, you're going to be assigned only at or near expiration if the option is already in the money. Now, if the option expires and it is in the money, meaning Tesla is below 250, then for sure you will be assigned. So you'll be obligated to buy 100 shares of Tesla at 240. Now, if you don't have enough money to sell cash secured puts, we will talk about this in a second. What are your alternatives? So stick with me there. But you will be assigned 100 shares of Tesla at $240. That's if you do nothing and Tesla expires below 250. Now, what I would do is I would essentially roll the option. What does rolling the option mean? If I sold the 250 and Tesla starts dropping before October 20th, the expiration of this option, I can essentially buy back that cash secured put and sell another one for the next month or the month out, and you can continue to collect credit so it's not costing you anything. So if I sold this cash secured put the 250 for $1,000 and I see that Tesla is dropping and it's making me uncomfortable and I don't really feel like getting assigned that month, I can roll that option to say November or December, same strike or even a lower strike, and potentially get paid credit as opposed to paying a debit in order to roll. And that credit just gets piled on top of the credit that I already received. Now, in terms of how to roll, you can Google how to roll or YouTube how to roll options on your platform. It's going to be platform specific, which buttons you click and whatnot. In Thinkorswim, it's very easy. You could just right click on your position, click on create closing order or create rolling order, and then pick your new expiration and your new strike price if you want to lower your strike price. And just monitor the credit and see whether you are getting some credit in order to do that, because you definitely don't want to pay a debit to roll. And if you do it early enough, you can continue collecting credit and pushing out that, kicking the can down the road and pushing out assignment essentially until the following expiration that you pick. Now, let's talk about the differentiation between selling options purely for income and selling options for an investment basis. For those of you that really want to get assigned Tesla shares, all you would have to do is go higher on your put, meaning more delta. So instead of selling the 0.3 delta for 250, for instance, you might want to sell the 0.4 delta at 260 and you would get more money, but there's a higher chance that you would get assigned. And some of you might want that, especially if you start selling calls against your shares, which we will talk about as well. If you were selling options purely for income, you would want to go at 0.3 delta or even lower. A lot of people will, just want to collect a few $100s every single month. So they might go to the 225 or 220 puts on Tesla and they're okay collecting a few $100s. And if they get assigned, well, the price is low enough that they're not really worried about it, because if Tesla drops from 268 to 220, how many of you Tesla fans or Tesla investors wouldn't want to buy Tesla at a $40 discount from where it's at currently? All right, so what do you do if you got assigned? Let's say that you got assigned those 250 puts on Tesla and now you buy 100 shares of Tesla at 240, because remember, it is the strike price minus what you got paid. Well, you can then go on to sell calls. So you can sell calls, and preferably you're selling calls higher than the price that you got assigned. So I would then say potentially sell the 300 calls in this case for almost $800. Let's just keep it round numbers for the sake of explanation. So I could sell the 300 calls for $800. Now you can only sell covered calls if you have 100 shares. There is another way to do it, which we'll talk about as well, but let's just stick to this example. So if you got assigned at 240, well, you can now sell the 300 calls, let's say in this case for $800. How do you pick the strike price that you want to sell the call for? Well, it's really just the price that you are okay letting your shares get called for, and hopefully it's in a profit. So if I sold the 300 calls on Tesla for $800, if I don't get assigned, meaning if Tesla is not 300 or more by expiration, then I get to keep that $800. If Tesla is 300 or more by expiration, then I have to sell these shares that I picked up at 240, but I'm not even selling them at 300. I'm selling them at 308, because remember, remember, it's going to be the strike price plus what I got paid in order to sell this call for. So I'm going to be selling Tesla for a profit of $68 a share. Now you can see how this can be lucrative really quick, because likely you're not going to get assigned either on the cash secure put or on the cover call on your first try. So you are going to keep getting paid for selling these options before you are finally assigned. This is how you are generating income. Now let's talk about how much money is actually required in order to do this. Well, if you have a margin account on a mega cap like Tesla, you're only required to put up 15% of the collateral. So selling the 250 puts on Tesla, instead of coming up with $24,000 to buy these shares, I only have to put up less than $4,000 if I have a margin account. Now, margin is going to differ by country, maybe by broker. So I'm just giving you an example of what it would cost on Thinkorswim in the US, right? I would only have to put up less than $4,000 in order to do it, but I do need a margin account. If you don't have a margin account, you're going to need all of the cash required to buy 100 shares of Tesla. So they're going to hold $24,000 from you in order to sell that put. Now, what do you do in the case if you don't have enough money? Well, like I said in the beginning, you can apply this to any stock you want to own. So if there's a cheap stock you want to own, whether it's Ford or Intel or Disney or a lot of the bank companies like Citi, JP Morgan, Morgan Stanley, a lot of the oil companies like Occidental, Marathon Oil, any stock that you're bullish on, you can apply this. But make sure you're only doing it on stocks that you actually want to own. Don't do this on willy-nilly stocks that when you get assigned, you start crying. You definitely only want to do this on stocks you want to own, but there's an array of stocks that are good starters for doing this if you have less capital. Now, what can you do if you wanted to do this on Tesla, but you don't have enough money? Well, unfortunately, you can't mimic it exactly, but there are still option selling strategies that you can utilize, such as a credit put spread. So a credit put spread is basically selling a put and buying a put. You're limiting your loss, but you're also limiting your max gain. So in this case, if I sold a credit put spread on Tesla, I would be selling the 250 and I'd be buying the 245, and that would give me a credit of $1.62. Now, why does this limit my gain and my loss? Because if I sold the 250 and I bought the 245, if I sold the 250, meaning that I would have to buy Tesla at 250 if I got assigned, well, what if Tesla tanks to 200? Am I asked out then because, I'm obligated to buy it at 250, but Tesla is now 200? No, I'm protected by the 245 put that I bought here, right? This is called a vertical spread. This is a credit vertical spread, or a credit put spread in this case, which limits my loss, because if I sold the 250 put and now I get assigned Tesla at 250, well, I bought the 245 put, which gives me the right to sell Tesla at 245. That's why the max value of any spread is $5, or the width of the spread itself. If it was $10, then the max value of the spread would be 10. So the max value of the spread is $5. Now, if I got paid $1.62 in order to sell this, so I got paid $1.62 in order to sell this, well, what is my max loss if Tesla is below 245? My max loss if Tesla is below 235 would be 5 minus $1.62, which is $3.38 if my math is correct, or $338. My max profit if Tesla is above 250 is $1.62. It just has to expire a penny above $250 in order for me to keep this $162. Now, you can close this at any time. American style options, you can close it at any time for a profit if it's up, or for a loss if it's down, if you don't want to incur the max loss, or you don't want to wait until max profit and risk potentially that option going from green to red. You can close your position at any time. So this isn't like selling a cash secure put in my view, because you won't be getting assigned the shares at a discount. You cannot then sell calls against your shares as well. So it is not the same thing, but it is an option selling strategy that to me is inferior, but you have the choice if you want to do it, right? All that Tesla would have to do is expire above 250 and you get to keep all of the credit. In my view, I would either rather find a cheaper stock to sell puts on and get practice with, or I would rather accumulate shares of Tesla at a discount if that is the stock of your choice, and then sell calls against those shares. And I would let my shares work for me until I have enough money in order to then sell a put and do what I described in this whole video basically, which is sell a put, keep the money, sell a put, keep the money, sell a put, get assigned, now sell calls against your shares, keep the money, sell calls, keep the money, sell calls, get assigned, sell your shares for a profit, and then redo the whole process over. So I would much rather accumulate 100 shares of Tesla, save up over the long run, and then be able to sell calls against those shares until I've accumulated enough income from selling those calls in order to then sell a put. This is if I don't have enough money yet to sell a put on Tesla, and I really want to do this on Tesla. Now, one last thing that you could do is sell a poor man's covered call. What is a poor man's covered call? If you don't have 100 shares of Tesla, you can buy what is called a leap, which is just slang for an option that is 6 months or ahead in expiration, and usually something that is really in the money because you are trying to replace the effects of buying a stock without putting up the capital required to buy 100 shares. So in this case, let's say again, we are in September. So let's say that I go out to March, I would buy a deep in the money leap on Tesla, which will be expensive, but will not be expensive as buying 100 shares. So I can buy the 90 Delta leap on Tesla for 104, which is $10,400, which is a lot less than buying 100 shares, which would cost me $26,700 at today's prices. But I would capture, the reason that you go deep in the money is I would capture most of the move of Tesla. So aside from determining the probability that a strike will hit, in this case 0.9 is 90% probability that Tesla will be 175 or above by March 2024. What Delta also denotes is how much money I will make if Tesla goes up by $1. So if Tesla goes up by $1, this leap will go up by 90 cents. So I'm capturing most of the move without having to put up the capital required to buy 100 shares of Tesla. Now, you would only do this if you were ultra bullish on Tesla. But what you can do is if you bought this leap, this 175 call leap for $10,400, you can then sell calls against your shares leading up to that March 2024 expiration. So you can sell, for instance, the 300 calls against your shares. And if you were assigned on those calls and you'd be obligated to then sell 100 shares of Tesla, you can then exercise your 175 leap and sell them for 300. Now, obviously that 175 leap, as we said, you bought for $10,400 or $104. And so your cost basis on Tesla is actually $279. So you can sell, like I said, those 300 calls and continue to collect premium on those. So in this case, if I sold the 300 calls for 800 and I was assigned on that leap, then I would still make a profit on Tesla, which would be 308 minus 279, which would be $29 a share. Now with the leap, you just have to be sure that you are bullish on Tesla because you can also lose a lot of money, almost as much money as it would take if you had 100 shares of Tesla. So if you had 100 shares of Tesla and the price drops by say $20, you were going to be losing $2,000 and you will lose a similar amount on the leap. So just keep that in mind. This is why this is not my favorite strategy when it comes to expensive options. I do like doing this on stocks like Disney or Nike, for instance, but on Tesla, unless you're really bullish or you're buying it at an opportune time, like when Tesla retraces 50% of a recent rally, it did this exactly twice, the last two times back in April and then also in August. Unless you're buying it at an opportune time or at a really base demand zone or support level, it's a very tough proposition to do this when the stock is this expensive. So just keep that in mind that you will incur a similar loss on the leap than that of buying 100 shares of Tesla stock, assuming the stock goes down, of course. Now, lastly, I will leave you with this. How do you earn more money on the collateral required to sell cash secured puts, for instance? Well, if you're on a broker like Fidelity, the good news is that Fidelity automatically does this for you. And I believe Interactive Brokers does, although check with them and make sure that you ask this question. Ask them what is their yield on their cash and sweeps vehicle, because that is going to determine what percentage you are going to earn on the money that is in your cash and sweeps vehicle. And also ask them if that is marginable, meaning the collateral that you are using for margin. Ask them if you can earn the yield on the cash and sweeps vehicle on the collateral that you use to sell cash secured puts. On Fidelity, I know that it happens automatically. Now, if you're on Thinkorswim, the yield on the cash and sweeps vehicle is crap. It's like 0.2 to 0.3%. So how do you earn near 5% on the collateral required to sell cash secured puts? You have to put it in a Schwab mutual fund. Sorry, Schwab money market fund. The one that I use is called SWVXX. Now do your research on Schwab money market funds. See which one is right for you. This one earns almost 5% a year. Now you have to go to TD Ameritrade's website or get on the phone with a fixed income specialist, and you have to purchase the SWVXX or whatever money market fund that you choose. You have to purchase that in the account that you actually sell cash secured puts with, and that account has to be a margin account. So keep that in mind. Now, after you put your cash in there, after 30 days, you can then use those funds in order to sell cash secured puts with. So not only are you making income by selling options or selling those cash secured puts, but any collateral required in order to sell those options is still going to earn 4 to 5% depending on the money market fund that you choose. By default, Thinkorswim will not do this, and most people miss out on money that they could actually make yield on while selling options for income. Anyway, traders, that is it for this video. If you got anything out of this video, leave it a big fat thumbs up. Let me know if you want me to make more videos like this. If you want access to all of our calls, all of our trades, all of the options that we sell, if you want access to my analysis, my day trades, our futures trades, make sure you click the link in the description and come and join us. Also, we are relaunching our mastermind. Mastermind 2.0 is coming October 3rd and will run every month thereafter. We take waitlist signups every month, and when they're closed, they're closed. So if you want to get on that, make sure you click the link in the description. And if you are approved, you're going to get a message letting you know that you are approved. As a matter of fact, I'm creating the slides for them right now. We're going to be going over technical analysis, trading, A+ setups, futures trading, options trading, etc. It's going to be 4 weeks, 8 classes. You definitely don't want to miss it. Make sure you click the link in the description and get your name on the wait list. Other than that, subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.